Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. Today, we're talking about common backdoor IRA mistakes and how to avoid them. Backdoor Roth accounts seem to be a popular topic with listeners of this podcast. The downloads for previous episodes on backdoor Roth accounts are higher than the typical download number per episode. Coincidentally, I've been working on this podcast script and was ready to record. Before recording, I happened to be texting with my sister. My brother-in-law recently changed jobs, so they rolled his 401k into a traditional IRA. She didn't realize this would impact his doing a backdoor Roth IRA, which leads us to the first topic. The biggest mistake or error when it comes to the backdoor Roth IRA strategy is either ignoring or not understanding the Pro-Rata Rule. Before you can really understand the Pro-Rata Rule, you need to understand the difference between pre-tax money and post-tax money. Pre-tax money is money that you've earned but have not yet paid taxes on those earnings. If you are a W-2 employee, your pre-tax money is your gross paycheck before all of the withholdings. You may have your employer take out money from your paycheck to contribute it pre-tax to a traditional retirement account, like a 401k or 403b plan. Your employer will indicate this action to the IRS and not withhold taxes on that contribution. On the other hand, if you have your employer contribute to a post-tax or Roth retirement account, your employer will withhold taxes on that contribution. The remaining portion of your paycheck that is deposited into your bank account is now post-tax money, since your employer has withheld the taxes owed on that money. If you are a 1099 contractor, there are no withholdings from your paycheck. It's up to you to pay estimated taxes to prevent paying tax penalties and interest later. An IRA is an individual retirement account. It doesn't go through your employer unless you're self-employed and set up a SEP IRA or SIMPLE IRA. When you contribute money from your bank account into a traditional IRA, you're contributing after-tax dollars. That money can be deductible, effectively becoming pre-tax, if your income is below IRS limits and depending on whether you or your spouse are covered by a workplace retirement plan. Most physician households earn above these limits, so contributions to a traditional IRA are typically non-deductible. Now that we understand pre-tax and post-tax, let's go over the Pro-Rata Rule. The IRS does not let you choose which IRA dollars you convert to Roth. The IRS treats all your IRAs as one big combined account and forces you to convert a proportional mix of pre-tax and post-tax money. If you don't have any pre-tax money in an IRA, then you won't have issues with the Pro-Rata Rule. However, if you have a SEP IRA or a SIMPLE IRA or a traditional IRA that has pre-tax dollars in that account, then you will be subject to the Pro-Rata Rule. Let's say you have a SEP IRA and you didn't know about the Pro-Rata Rule. You plan to use the backdoor Roth IRA strategy to contribute to a Roth IRA. You open a new traditional IRA account and contribute $7,000. Let's say your SEP IRA has $93,000 in it. Now, if you combine your IRAs together, you have $7,000 of post-tax money and $93,000 of pre-tax money. The IRS doesn't let you convert only the post-tax money when you make your Roth conversion. Think of it this way. Imagine a big pot of soup. The soup is 93% broth and 7% vegetables. When you take a ladle of soup out of the pot, you can't just take out only the vegetables. You're going to end up taking out some of the broth of the soup as well. The IRS says that your Roth conversion works the same way. If you convert your $7,000 contribution to the traditional IRA into a Roth IRA, the IRS says that only 7% of that money is after tax. So that portion won't be taxed, but that 93% of the money is pre-tax, and so it will be taxed as ordinary income. In this instance, for $7,000, $490 would be tax-free, and $6,510 would be taxable. This is in proportion to that $7,000 of after-tax money you put into your traditional IRA and the $93,000 that you had of pre-tax money in your SEP IRA. To determine the portion of pre-tax and post-tax money, the IRS looks at your IRA balances on December 31st of the conversion year. It does not matter when you made the contribution or when you did the conversion during the year. What matters is what's left in any traditional, SEP, or SIMPLE IRA at the end of the year. Any traditional IRA, including a rollover IRA, SEP IRA, or SIMPLE IRA, counts towards this pro-rata rule. 401ks, 403bs, and 457 plans, as well as Roth IRAs, or Roth of any account, do not count for the pro-rata rule. This means that if you roll over your pre-tax money from a traditional IRA into a traditional 401k or 403b plan, then you could avoid the pro-rata rule. However, your employer may not allow rollovers to your employer-sponsored retirement account. If this is the case, consider creating a side business so that you can open up a solo 401k. Make sure that you open your solo 401k with a custodian that allows rollovers. You may also have to wait 2 years before you can roll over a simple IRA. This is why I recommend using a solo 401k instead of a SEP IRA for 1099 income. There's a whole episode that talks about solo 401ks versus SEP IRAs, so make sure to check that out if that's of any interest to you. Another option is to convert all the IRA money, pre-tax and post-tax, into Roth. In the above example, you would end up paying ordinary income taxes on the $93,000 that's in the SEP IRA, which is not ideal. However, if you are in a lower tax bracket due to taking some time off work or for some other reason, this may be a reasonable strategy. You may be wondering, how does the IRS know if the money in a traditional IRA is pre-tax or post-tax? The IRS does not track after-tax basis for you. You need to file a Form 8606 to prove your contribution was non-deductible and that you already paid taxes on it. Which leads us to the second set of mistakes that happens with backdoor Roth IRAs, which is 1. Not filling Form 8606 with your tax return. 2. Making errors when filling out Form 8606 with your tax return. Or 3. Not checking your accountant's work on Form 8606 and catching any of their possible errors. You need to file Form 8606 every year you contribute post-tax dollars into your traditional IRA. If you have a spouse and they contribute to their traditional IRA, then a separate Form 8606 has to be filed. To put it another way, if you're married filing jointly and both you and your spouse contribute post-tax dollars to a traditional IRA, then 2 Form 8606s need to be filed with your tax return to the federal government. Form 8606 is actually pretty straightforward to fill out. If you read each step, it actually does make sense. That being said, as smart as we physicians are, we can still mess up on simple math. Remember that 1 divided by 1 is equal to 1 and is not equal to 0. I'm sure that there are people who read the word divide, but instead perform minus. If you would like to see an example form, check out my blog article on this subject at www.growyourwealthymindset.com. If you use software or an accountant to file your taxes, make sure that the Form 8606 is filed correctly. I had a past accountant who did not file out the form correctly, causing me to pay double taxes. I ended up firing her and hiring another accountant to file amended taxes. It can be hard to find a good accountant. Now, let's talk about when to make contributions and when to do the conversion. While you can make a contribution until taxes are due on April 15th the following year, meaning you can make your 2025 IRA contribution up until April 15th, 2026, I personally believe it's cleaner to make the contribution in the year it's for. Make sure it's clear which year the contribution is for when you're making the contribution. When you set up the money transfer into your IRA account, the account should ask which year the contribution is for. Make sure you select the correct year. I don't want you to not make a 2025 contribution if you haven't yet made it and it's before April 15, 2026. But make sure you make your 2026 contribution this year and don't wait till 2027. In my opinion, if you're doing the backdoor Roth, you should make one contribution for the maximum allowed and not make multiple contributions that add up to the maximum. For 2026, make a $7,500 contributions for those who are under age 50 all at once. Make a single $7,500 contribution. Don't contribute $2,000 now, $3,000 next month, and then $2,500 in 2 months for a total of $7,500. If you don't have the $7,500 to contribute now as one contribution, then I advise you to wait until you actually do have the $7,500 before making any contributions. If you're age 50 or older, then you can contribute $8,600 into your traditional IRA and convert that to your Roth IRA. While technically it's not wrong to make multiple contributions over time, it just makes things more messy. And I think it's worth avoiding doing that. Once you make the contribution and the funds settle, convert the money right away. Don't let the money sit in the traditional IRA. Convert the money from the traditional IRA to the Roth IRA. Ideally, the contribution is converted within days, not months. If the money grows, the growth is taxable at ordinary income rates when converted. While this isn't catastrophic, it does defeat the purpose of keeping the backdoor clean and simple. There's no reason to pay taxes when it's easily avoidable and make things more complicated than necessary. Don't worry about a few cents of growth, but the less growth and time the money sits in the traditional IRA, the better. Often, I find for married couples, one person in the relationship handles the majority of finances. I certainly do this for my household. While I always advocate spouses to discuss money with each other, I acknowledge that it's usually one person who takes the lead. When it comes to retirement accounts, it's a mistake for spouses to not coordinate with each other. Although the income limitations for taking a deduction for a traditional IRA contribution or contributing directly to a Roth IRA is the combined income for the married couple filing jointly, each spouse has their own IRA with the federal IRA limits and their own pro-rata calculation. If one spouse is over age 50 and the other spouse is under age 50, then they will have different contribution limits for their IRAs. One spouse having a SEP IRA does not affect the other spouse. Each spouse needs to do their own clean backdoor Roth IRA setup, including filing their own Form 8606, which I mentioned earlier. Some high earners avoid the backdoor Roth entirely because they think it's a loophole that might get them audited. Rest assured, the IRS has explicitly acknowledged this strategy, and Congress reaffirmed the legality with the conference report that went along with the Tax Cuts and Jobs Act of 2017. The backdoor Roth is widely used by high-income professionals. The risk isn't doing it. The risk is doing it incorrectly. And please, don't confuse a backdoor Roth with a Roth conversion. They are related, but they're not the same. A backdoor Roth is a process of making a non-deductible contribution into a traditional IRA account and then converting it into a Roth IRA account. A Roth conversion is moving pre-tax money to a Roth account, which is a taxable event. Sometimes people convert a large pre-tax IRA thinking it's part of the backdoor Roth IRA strategy and inadvertently generate a huge tax bill. There are times when someone does a Roth conversion, but don't confuse doing a Roth conversion with the Backdoor Roth IRA strategy. The Backdoor Roth IRA strategy works best when coordinated with employer-sponsored retirement plans, solo 401ks, tax bracket management, and long-term Roth versus pre-tax planning. Using it on its own is fine, but when used strategically, it's a powerful vehicle for retirement planning. If the Backdoor Roth makes sense for you, make sure that you are doing it cleanly. Generally, it's best to contribute annually and file Form 8606 along with each annual contribution. Missing or incorrect Form 8606 can cause headaches to clean up later. The Backdoor Roth IRA is not complicated, but it is unforgiving to small mistakes, especially when it comes to the Pro-Rata Rule and Form 8606. It is a powerful tool to help build wealth and manage taxes during retirement. Do you still have questions about the Backdoor Roth IRA strategy? If so, shoot me an email at growyourwealthymindset@gmail.com. I'd love to hear any feedback about this episode or the podcast in general. Have a great week and happy investing. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician, so if you need any medical advice, please contact your own physician. Thank you.